Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a 20-year candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. Last week, I had a special edition report where I sent out a link on the silver markets through Ed Steer. Hopefully, you had a chance to listen to that. If not, go back to last week's report and you'll see the link in the description box below the video to give you an idea of what's happening in the silver market. And I am still very bullish on silver. This could very well be another opportunity to accumulate at the lower levels. However, looking at the diamonds, I talked about an overextended market. I talked about the divergence in the CCI. Again, recapping what I said last week, I said we have higher highs on price. We have lower highs on the CCI. If I zoom into the daily chart, you'll see we had a lot of activity today where the forecast from 2 weeks ago, we've absolutely hit that target. And guess what? We're now closing below that 20-period moving average. And not only are we closing with a big, strong red candle right there, but this red candle follows a bearish engulfing pattern from Thursday's close. And we're doing that on much higher volume. So what does that say? That's telling us that the sellers are becoming more motivated. You can see that the stochastics down here is still heading lower. The CCI is still heading lower. No signs of a hinge or a pivot point at that particular point. However, we still have a gap below the market right here in the diamonds. And that's where my forecast is going to be for next week. I think that we can move lower to fill that gap, and then we'll have to see whether or not we bounce from that gap. If you're following my gap trading principles, you'll know that gaps fill, and after they fill, there's that gap again. After they fill, we generally get these bounces because they become price targets for those who are trading against them. So in other words, if there's a trader who is short the market and they're looking to cover that short, they will most likely cover at the target price, and that's why a lot of times we get those bounces. So that's for the diamonds. If we take a look at the Qs, ticker symbol QQQ, NASDAQ market through the ETF right there, you can see that we hit all of my targets from the previous week before, and we even came down to test that support level. Now, what's happening with the Q is very interesting here, because what you might think of as a key support level, you have to pay more attention to the resistance. And look back here, you see that 20-period moving average? I have it highlighted in blue. That is giving us a good reference to the monthly average price, because it's 20 trading days in a given month. And for the most part, it's held as support here, here, and here. Well, there's a thing called role reversal, which I talk about quite often. And now that the moving average is starting to roll over, like we see here, that moving average is now going to act as resistance. So my forecast for the Qs and the majority of the markets that we're looking at, including individual stocks, that moving average is going to act as that resistance, and we could see a little bit of a zigzag to the downside. So keep an eye on that, because you need to be very mindful of any long positions. Keep your stops below these key support levels and make sure you're using good risk management technique. Now, again, to draw my forecast, I think we're going to go lower, just like this. And I'm not going dramatically lower, but that's mainly because the volume is still very high. Oscillators here and the stochastics still going lower. And we have the next support level right down here. So I'm going to erase this support level, keep the newest support level in check. After we pull back and test that support level, we're going to have a wide divergence from that moving average. You see that? So if we extend a little bit more, that rubber band effect is going to kick in. I talk about that quite a bit, because if you had one end of a rubber band, more or less an imaginary rubber band, connected to that moving average, and the other end to the price, as the rubber band gets stretched away from that moving average, it has a tendency to snap back to that moving average. So that's what we're looking for here in the Qs. As it becomes more overextended to the downside, we'll have to start looking for bounces. And even then, I'm not going to be, madly bullish. I might be slightly bullish on any support level, but this is another testament to why option trading is so successful, especially for our members. If you're a member and you've been following along, we're having a great time, especially in stocks like GME and Lulu and some of the other ones that we're trading. We even traded the VIX. We went long on the VIX through the call. So again, if you're interested in learning about option trading, again, just get a lesson, not even putting your money at risk, just getting that lesson and learning how. We have courses available for you, and you can click on any of the links in the description box as well, and we'll have one of the representatives help you there. Now, let's take a look at the IWM. This is the Russell 2000. You can see here that, again, my forecasts were hit. We came right down to that. This is from 2 weeks ago, because remember, last week we did the special edition. I said we'd go back to the weekly forecasts, and here we go. There's a slight gap fill down here, and this support level is still in place, and we have a gap support down at this level. Now, again, yesterday we had very close to a bearish engulfing pattern right here. Not quite, but very, very close. Today, we have a close below that 20-period moving average, and we're doing so on higher than average volume there. So again, the sellers are motivated, and what we could see is a little bit of a bounce off of that support level, and then we'll have to see whether or not we want to tiptoe into a shorter term long position, whether using options or equities. So again, my forecast is going to be to the downside for the IWM, and we'll have to see how that works out. Now let's take a look at the VIX. Volatility Index hit precisely. I did put a 2-week forecast out on the VIX. You can see that started back here, and I just simply projected out right there. And we had a target to fill the gap right there. See that? Again, with the VIX, 100% of the gaps filled, because it's not a trending stock. It's an oscillating index. So when the VIX gaps up or down, like we see here, it gapped up, came right back down to fill that gap. You'll see that the gaps fill quite often, and a lot of times it doesn't take long for those gaps to fill, but we hit the target. Now this is going to be a little bit different for the VIX, because we got the oscillators more or less hinging down on the CCI. Let me erase this right now, and I want to keep this support level in check. I'm going to keep an eye on that. And we want to keep this resistance level, which is the gap fill point right there. I think we could see a slight pullback in the VIX, but then ultimately I'm going to go out with the 2-week forecast on the VIX right there. So again, for the option traders that are spread traders, have some patience, because if the VIX starts heating up and you're getting ready to roll your spreads, the months that you roll into are going to be beefed up with volatility premium, which means you're going to be collecting more credits on those rollouts. Not to get too heavily laden with option strategy here, but it's important to understand that, again, with all that we're seeing in the world, this is heaven for the option traders, because we make money on the way up, on the way down. When the market lays flat, we have some really strong positions on. We've been making money all year long. And you could even be wrong. If your stock moves against you and you're positioned correctly, you can make money with a call spread if it goes against you. You can make money with a put spread if the market goes up. And we've done that before. With GameStop, I'm just going to throw this out there for all of you. GameStop has been a wildcat of a stock. We actually took a put position on right here, and the stock went up $200 against us. And because it was a volatility explosion, it came right back down. We're making really good money. In fact, this is on track for our spread to be paid off in less than 2 months, where hopefully, if everything goes right, we will be in a risk-free position that will continue to pump money out for us each and every month as we roll for credits. And again, for those that don't trade options, that might seem a little foreign, but don't worry, you can learn. and take it at your own pace. There's lots of folks on our team that would be willing to help you, and that's our goal, is to educate the public on how to trade and to manage risk. Now, finally, I talk quite a bit about silver in the past. I'm still very bullish, as I mentioned before. Put SLV in here for you. Now, SLV is a position that I do hold. I'm just letting you know that. And one of the reasons I'm still bullish is because we're in a trading channel here. We just recently filled a gap here. So for the shorter term traders who would even like to swing trade SLV, it tends to stay in this range right here. And there's another gap fill support level down below. So it's giving you enough range and volatility to be able to trade that. And for the option traders, again, you can position yourself long term for a lot less money than if you were to buy the underlying. And silver looks really strong, especially on the long term. I'm not going to pull up the 50-year chart, but I eventually will be talking more about that in the reports ahead of us. Now, as a contrarian, understand, contrarian theory does not mean that you're going against the crowd every time the market moves. A contrarian recognizes the trends, and then the contrarian looks for news that might switch or sway popular opinion the other way. Now take a look at what's going on. This is right from Yahoo Finance 26 minutes ago. Check this out. Look at the headlines here. Americans can't file their income taxes fast enough, but they should brace for some unwelcome news in their 2020 refunds. Well, that's not very positive. Now, look at Paul Singer, Ones of Trouble, right? Again, I'm not saying he's right, he's wrong, but that is a headline that could catch the attention of someone who has been long, and they say, whoa, I don't know, Paul Singer might be right. And then they look further down, they see how the Fed is on a collision course, right, in the Treasury market. The yields are going up, and that's what the big news was today. The yields going up is bearish for the market. It's really pretty bearish for the economy because that might be a sign of inflation. It would cost more to finance our debt with higher interest rates down the road. We're already on that threshold of no return, more or less. And so these are the kinds of headlines that I look for in the market, and it supports what we're seeing on the technical charts as well. So make sure you're paying very close attention to the charts. You're watching the news. You stay in touch with my weekly market reports as well. And just make sure you keep your risk management plan in place. With that, you have a great weekend. Thanks again for sharing and liking and commenting. I really do appreciate that. Our channel here is growing mainly because of word of mouth, and eventually we'll hit that critical mass and really take off and help a lot more people. But again, it's thanks to you and sharing and liking our page. It really helps get the algorithm going to come up in a lot of the search engines, so it really helps quite a bit. So again, thanks and have a great weekend. So long.